Hi, welcome to my YouTube channel. My name is Phil Grandy of philsgang.com, Phil's Gang Podcast, and Phil's Gang Syndicated Radio Show. Well, Friday the 13th, just a few days, we're going to have earnings season. And earnings are going to be butt ugly. But the analysts are going to turn around and say, oh, no, this is good news. This is telling us that this is the end. We're not going to go down anymore. The markets, this is the bottom. And why would they say that? Because they're going to find out. They're going to say, well, the last quarter of 2021, we had profits of 34%. Well, 2022, the last quarter, we lost all that. We're down minus 4%. Now, you think the market would collapse? No. What they're going to do is spin it and say, well, bad news is good news. And they're going to try to rally the market. That's what they've been doing. But it's not going to work. Because every time they rally the market, it doesn't work. Because they're screwed up. And that's why the market is going to drop below the October's lows. Now, there's a caveat with that, because I always tell my students, the market always does what it's supposed to do, but never when it's supposed to do it. And they could simply turn around and say, you know what? Screw Main Street. Let's bring interest rates back down to zero so we can make the wealthy much more wealthy than they already are. But look at over here on this chart. Let me explain something to you. The reason they told us inflation was transitory, they were trying to mask what they were doing. Back in 2007 to 2009, during that recession, they dropped rates from 5.2% to zero. We're raising rates, just the opposite, from 0 to 4%, just the opposite. That's why they kept saying to you, hey, inflation is transitory. They were masking the fact, that they had to say something why they're raising rates when the last recession they reduced rates. Now you can take a recession and you take inflation rather, and you can break the back of inflation by taking, and if your inflation is 8%, raise rates to 10, 12, 15%. That's what they should have done. They didn't do that, right? So they're trying to break the back of inflation of 8% by raising rates 4%. What are you, nuts? That's not going to work. So they masked that, telling us, don't worry about inflation, it's transitory, because they didn't want you to look back here and say, wait a minute, what are you guys doing? Back here, you lowered rates. Back here, you're raising rates. But here's what's interesting. Here in 2009, when rates hit zero, look what the stock market did. It exploded. Because they kept rates at zero already all the way up to 2015. Then what happened? Yellen, then Powell, 2015 to 2018, raised rates 9 times from 0 to 2.5%. That's when the market started to crack, right here. That was the first crack in the market, 2018. I warned about that, remember? In 2018, the market dropped about 31% in about 16 weeks, and then rallied 54%. Then the market dropped again in 2020, about 32%, but then she rallied again, 133%. But it stopped. The rallies that we had like this were all due to zero rates, but no more. And they stopped with QE and zero rates in November of 2021. And they started to raise rates. You can see it right here. See what rates do? When they started to raise rates, right in here, look what happened. That's where we got the first crack, 2018, 2020. And look at this right here. This is in January of 2022 to where we are today. So look what they did. When they took over, they raised rates, then they dropped rates. And then they raised rates again. They don't know what the hell they're doing. But here's the problem. On top of the fact that they're raising rates in a recession, remember, wages, we just got those numbers. They made it sound terrific, just like they're going to do on Friday. When we drop from 30% to minus 4%, they're going to do the same thing. They're going to say, well, we estimated it was going to be much worse than this. Remember? They said wages only went up 4.6%. We estimated it was going to go up 5%, but they never told anybody that 144 months straight it was at 2.3%, then jumped up to 4.6. They didn't tell you that. They said, oh, we estimated 5%. They're going to probably play the same trick. But here's what you got to think about, and this is why the market is in severe trouble in the economy. The mortgage debt is a killer. The mortgage debt is a killer. We've never adjusted the overvaluations in these homes. They're overvalued, just like stocks. We never adjusted the valuations in stocks. So the mortgage debt from 2018 to 2019, for 11 years, took 11 years for that mortgage debt to go up to $100 billion. Then it only took 1 year from 2020, 2019, 2020 to go up $100 billion. So think about that. It took 1 year to go $100 billion compared to 11 years going up $100 billion. Then 12 months later, we're at $245 billion. 12 months later, we're $282 billion. This is amazing. And what was happening is house prices were going through the roof. So people came in and refied. They were taking out $320 billion a quarter. Then what happened in November 2021? The market, the home equity started to dry up. November 2021 dropped $63 billion. A year later, November 2022, dropped $1.5 trillion. On top of that, credit cards are tapped out. People are tapped out with their refis. Their savings has gone to hell because remember, 32% of disposable income, that's what it was in 2020. Today, it's 2.2%. Savings 2.2% of disposable income. So they don't have any savings. They don't have anything. No more refis. They have no money to pull out. Nothing left. And the credit cards are tapped out. And they're raising rates. And they're going to go higher. So that's why this market, the only way they can stop this market from dropping, going all the way back down. Know what I'm saying? I'm telling you that I think the market's going to go all the way back to these lows right here of 2018, 2020. That's what I think is going to happen, okay? But we'll see. So going into the earnings season now, they're trying to push the market up as much as they can to build a cushion. But what I just showed you between the mortgage rates, okay, I mean the mortgage, the equity in these homes have been ripped out, but we haven't really adjusted the value of homes. They haven't dropped. They really haven't dropped that much. That's the problem. The other problem is that the valuation stocks haven't dropped that much. That's all going to change within this year. By the third quarter, you're going to see a ton of people who have been laid off. By the third quarter, everything I just explained to you, everything I just showed you, they're raising rates, it won't work. You're going to see a massive crash in the market. You're going to see home market, housing is going to just collapse because how could you take and have a mortgage debt in 1 year go up $100 billion where it took 11 years? Or it took 1 year to go up $245 billion. It took 1 year to go up $282 billion when it took 11 years to go up $100. That's why the prices keep going up and up, and nobody's readjusted the prices in homes, and nobody's readjusted the prices of stock. So that's where we stand. So it's going to be very interesting. So get ready, learn how to short. Now, if they do, they may do this. They could be as crazy to turn around and decide to go back to QE. Oh, they could pivot back to QE, bring interest rates back to zero again. They do that, they'll kill the economy. So learn how to short, please. You got to learn how to short. So I'll see you on the charts. Thank you.